Hey everyone, my name's Andy from the Finding Value Finance channel. I'll be your host today. Today we've got Shubham Garg from White Tundra. You can find him on Twitter. At least that's where I found him and asked, what was that, some time ago. Actually, how long have we been talking? Probably about 6 months, a year, something like that.
Yeah, probably 6 months at least. Yeah, maybe a bit longer
at
than
least.
that. Yeah, you bet.
Yeah, so I wanted to get you back on. Thanks for coming on. Appreciate it. And I want to talk obviously about oil. I know a lot of people are getting worried about the markets prices coming down. Again, whatever their thoughts go up and down with the price of oil. So first off, how do you handle these up and downs in the market? And what do you focus on to keep you motivated or to keep you on track for the oil bull market? So kind of, does price drive narrative, or do you just not even look at price and focus on something else? And what is that something else?
Yeah, so I guess there's a few things there. I think price does drive narrative a lot of the time. We just saw this recently where if WTI is coming down, then that must mean demand is not looking good. This is the prevailing narrative. So, well, in 2010 to 2014, we saw demand going up, and yet prices were still up. In 2015 to 2019, prices were low, yet demand was still going up. So you can't really use WTI price as your demand indicator. We saw the same with diesel just happen, where diesel cracks are coming down, therefore diesel consumption must be falling off a cliff. Well, that's why I posted on my Twitter feed that diesel demand by continent looks really, really good. So price does drive narrative. We are obviously in a more social environment. If I was just investing on my own, there's different things that I look at. But as far as for the retail investor or the investors on Twitter, I think who maybe don't have all the data sources, we're using Bloomberg, we're using Reuters to kind of figure out what's happening. They were also pumping these sort of narratives. So definitely, the first point I want to make is just keep that in mind, is that WTI or diesel or cracks is not a reflection of demand at any portion of time. It can be an indication of physical undersupply or oversupply, but that's over a longer period of time. When you have short-term movements over a week, it's most likely related to the commitment of traders, how much open interest there is, and then over a period of time, that sort of drives the which way the prices are headed, whether they're up or down. As far as what I'm looking at, there is obviously now two sides to the market. I would say about 6 months ago, there was only one side of the market that I was really tracking, which was the physical side. I looked at pure undersupply, supply, demand, and then inventory. I still track that right now. We can probably get into some of the data points as we go on, but everything there is looking relatively the same as what the thesis said. I'm not going to say that things are booming or that we're going to hit $150 oil tomorrow, but everything according to the thesis is looking good. Supply is not rebounding. Demand is looking a lot healthier than what the prevailing narrative may seem you to believe. And then onshore crude inventory has been down the last 10 weeks in a row and 12 out of the last 14 weeks. So we are seeing healthy draws. We're seeing refining capacity come back online. And then we're seeing overall product consumption continue to rise, buoyed by the international jet fuel return. So every day, every couple of days, I see, Air China is now back from Shanghai to Auckland in New Zealand, or Air New Zealand is doing that same journey. Etihad, Emirates, we see United and Delta are beginning their flights to Greece here, May 6th, May 7th, May 8th. And any flight that's about 10 hours, long haul, intercontinental, is about 500 barrels of consumption. So every single day, you're getting 5, 7, 10 of these flights being added. You can run the math over a month. It adds up to tens of thousands of barrels month after month after month. So we are still seeing that sort of recovery continue to happen. Anybody saying that China is fully reopened is obviously not tracking the flights that have come online after 3 years, and they continue to come online week after week. But then the second part of the oil markets now is the financial side. And I would say this is where I have had to adjust my own view on things. I would still argue that in a 0 to 2% to 3% interest rate environment, Fed funds rate environment, the paper market cannot be in control. The physical market, if it's an undersupply, will be the one that drives where that physical barrel is going, where the WTI price is going. In a higher now interest rate environment, 4.5, 5, 5.25 now we're at on the Fed funds rate, there's a few different things that happen. So number one is the open interest comes down. Because WTI contracts are held on margin, you are taking on a lot more risk, and also you're paying a lot more margin cost. So if XYZ bank wants to hold these contracts, they're now paying 5, 6, 7, 8% interest to hold this, that portion that's on margin, and they were paying 1 or 2 or 3% earlier. So there is a natural drawdown in open interest. We see this with the CFTC, I believe it's CFTC commitment of traders data, and that's something that comes out every week, so we can track that, see how things are going, who's long, who's short, both on the institutional and then on the more retail side of things. You also have more people who don't want to participate at all. They say, I can get 5.5% or 4.5% in my Wells Fargo or Charles Schwab savings account. Why should I play in these markets? I just don't care. So they'll go in there, they'll pump their money into that thing, and then they effectively have left, whether it's the commodity side of the markets or the equity side of the markets. So these two things are major factors, and they create low liquidity. You saw what happened after close yesterday, a $5 drop in WTI in 30 seconds or 1 minute, completely not normal behavior, unless you saw some sort of nuclear bomb activate somewhere. Maybe you could see this sort of action in the physical market, but there's just so few participants in the market. It's very easy to push the price of oil down. And then once it goes down, just the way the delta hedging works around these, you just got to keep pushing it down. Once that wave stops, then it stabilizes, and then we make our little recovery. One extra point here, China has been under May Day holidays until Wednesday. So a lot of their traders, a lot of their, oil market participants have been not in office. So they've been out vacationing, they've been out traveling, and now they're back on Thursday, which is today. And guess what happens? The selling suddenly stops, and you see this push up in the oil markets. Europe also had holidays earlier this week. So you just saw nobody in the market, and well, bam, we got this bank news, we got the First Republic issue. Last night we got the PacWest Bancorp issue. The Fed raised 25 bips again, and it's all just became a perfect tornado to just slam oil. And keep in mind, this is not people shorting oil. This is long contracts leaving the market, which results in the natural price coming down of oil. So I think that's kind of where we are in terms of summary. And if before we get into the other questions, the one point I will just get all the listeners to think about is what is priced in. So when you look at oil price, just think about this. You're saying there's a recession coming. You think there's demand destruction coming. You think there's a banking issue, credit issue. How much of that is already priced in? If WTI was at 90, maybe, it's a subjective question. So you think about that. When WTI is at 65 or 68, how much is now priced in? So just think about that as you make your investment decisions here, and think about the oil markets and the different factors here, because there's a lot of stuff happening all at the same time.
Yeah, so I just want to make sure I got this right. You think that the physical markets are going to drive the paper markets in a deficit or shortage. So then, if that is the case, which I also think is the case, what does our inventories look like worldwide today? And what do you think they're going to look like in a year from now? Are we going to be running deficits where it's going to eat through inventories, hence pushing or pulling that price higher? What's your opinions around the deficits out in the future and inventory levels worldwide, at least today, and then in the future, maybe a year from now?
Right. So excellent question. I'd say right now, the paper markets are in control as we speak right now. What we need for the physical markets to come back in control is a over-exaggerated deficit. So right now we have that 1 million barrel per day, something like that deficit. We need a exaggerated deficit that comes in and absolutely clobbers anybody looking to buy physical. They can't find the barrel, and anybody that is shorting the barrel suddenly thinks, oh, hang on a sec. If I keep shorting this barrel and I can't find it, I got to buy it for much higher on the physical market. It doesn't make sense to take on that sort of risk. So we saw this happen, plus a bit of speculation happen last year, late Q1, early Q2. Right now, we are in a relatively undersupplied market, but not enough that the physical market is in control. So what changes to get the physical market in control? That's the question. Mm-hmm. So the one thing I will say is whenever you see recessionary narratives, whenever you see demand destruction narratives, a lot of the recession and demand destruction impacts of petroleum have already happened. When you tell people for 6 months and a year, oh, if there's a recession coming, you might get laid off, you might lose your job, prices are going to keep rising. What do people do? They stop spending. They stop booking random things. They stop driving unnecessarily. People have already made that shift. You see this in some of the changes that have occurred in people spending over the last 6, 12, 18 months. So there's kind of a bonus here coming when people realize, okay, well, things are maybe not as bad as they seem in the real world. And maybe the Fed pause is what creates that, or just general better overall economic data, which we're seeing. We're seeing really good data kind of across everything: home building, construction, real estate, travels, flights. Flight bookings to Europe are up 60 to 80% year over year. These are big numbers. These numbers don't happen in a recession, in your typical sort of recession. So one thing is that the recession impacts are already priced in. When that mindset changes in the average consumer in America, let's say, or in Europe, you're going to see a boost in demand there. The second thing is China continues to open. For all the narrative that China didn't open or they haven't opened, they are at all-time highs for demand. This is a true number. You can get this number by looking at their crude imports, subtracting their refinery runs from that, looking at their product inventories and their crude inventories, and then their product exports. And that tells you, okay, what is our internal demand? In China, it's looking really, really strong. It continues to increase. Flights from Hong Kong to China, Japan to China, things like that are still picking up. Keep in mind, China just ended their PCR test requirement on April 29th. So until now, you had to have a PCR test within 48 hours before you enter China. That has changed. Japan on April 28th just ended their COVID-19 vaccine requirement. On May 8th, they end all COVID testing requirements. So these things do affect people. When you're traveling with kids and you got to get 4 tests done, and then you got to go there, you might be subjected to random tests. You say, we'll just wait. We'll wait another couple of months, and then we'll book this travel. And we see this. I shared this statistic earlier as well, that if you look at all the travelers that are leaving China, 24% or so used to be families. Now it's down to 11%. So this huge increase in family travel and then group travel is yet to come. We're going to see that continually boost. So those are the things on the demand side. I'm not really going to speculate on any other things. We're just seeing overall global resurgence. People want to travel. They want to meet others. They're tired of looking at screens. They're tired of staying home with all these restrictions. Now on the supply side, one thing that has flown under the radar completely is that US supply is not looking good. So US supply has been flatlined at 12.2, 12.3 million barrels per day, almost 5 to 6 months now. And then on top of that, there's a double whammy. We are down over 100 rigs, according to Enverus, since October 2022. So now we know shale is a high decline acreage. Each rig that gets dropped has an impact in month 1. By month 3, there's a compounding impact to that rig being dropped. By month 6, you've lost 5, 7, 10, 15 wells that would have come online to mitigate that steep base decline. Now multiply that by 100. There's 100 rigs that are offline. Since then, we don't have any DUCs anymore. In early 2022 till today, we've blown through another 500 DUCs, drilled uncompleted wells in the Permian. So all of this has a compounding effect that plays out over time. It's not an immediate impact, but it just snowballs and it goes on top of each other like a staircase. And we'll see this play out throughout 2023. So anybody that thinks that, hey, just because we saw oil price come down, like everything is fine on the supply side, no, there is a price to pay. When you keep WTI below 80 for 3, 4, 5, 6 months, there's a price to pay on the supply side as well. And it's not just shale. There's other projects that keep getting pushed back worldwide, conventional projects, etc. Excuse me. And then one final point, demand is going to be much higher at $70 WTI than it was at 110, plus the $60 crack spread margin last year. Today, we see crack spreads $27, $28, $30 a barrel. The consumer has already found a lot of relief from inflation and from higher pricing on services. So we'll kind of see that play out as well over the next few months.
You know, I've heard some numbers thrown around. I just want to get your opinion on it. Some people were talking about deficits in oil later in 2023. They were talking 4, 5, 6 million barrels a day. Does that seem legit? Does that seem like a good number? What number? I mean, I don't know if you make those projections or anything like that, but does that sound right to be in that ballpark? Or does that seem overly aggressive in terms of the deficits that could be running towards end of 2023?
Yeah, so unfortunately, we're never going to get to that sort of deficit because the price would rise sufficiently to hit demand destruction levels before we got there. But one point I didn't even mention in my last point here is that OPEC just cut 2 million barrels per day as of 3 days ago. So we already saw OPEC crude exports drop in week 3 and week 4 of April. They kind of front ran the cuts. Of course, some of that was involuntary, the Iraq problems, the problems in Nigeria, but still OPEC as a whole seems to be coming down already. But as far as deficits go, I think 5 to 6 is just way too aggressive. If you told me today that WTI is at $70 a barrel and the Fed funds rate is going to get cut to 1 or 1.5%, yeah, there could be some crazy deficits that would happen. But where we are today, there is an impact of the 5% interest rate, not just on the financial side, but that impact there is on the physical side as well, and then the recessionary narrative also driving that. I think we get to about 1.5 to 2.5 million barrels per day by the latter half of this year, and really that's when OPEC is going to have to start adding barrels again. The same way they brought back their COVID cuts, I think they're going to do the same thing. They're going to add 3, 4, 500,000 barrels a month, as opposed to, oh, we're just unwinding all the cuts at once. They're not going to do that. So you're going to see them slowly add barrels, ease into that deficit, and really at the same time continue to draw down inventories. They did a really good job in 2022. They were able to get over 250 million barrels out of the US SPR. The one bullet that the world had for just excess free crude sitting around that was congressionally mandated to get brought down anyways. They were able to get that bullet fired, and China kind of helped them. Well, China went against them in a sense because they shut down a lot of last year. Now they're back at full speed. The global economy seems to be doing relatively well compared to the I call it the Twitter demise of everything's going to collapse. We're going to move to this and that. That just has not happened yet, and I don't think it's going to happen. So I'm thinking somewhere between 2 to 2.5 to 3 million barrels per day is where OPEC needs this to really get that physical market to be back in control. And then once they've drained down inventories, another whatever 200, 300, whatever million barrels they think they need to get rid of all safety nets, they will then start to increase production and get it back up to more of a sustainable, I call it undersupply, because the world in a 2+ million barrel per day undersupply, it cannot sustain there for any sort of long period of time. And the one thing that's helping the oil bulls this time around is the refining complex. We went from a undersupply in refining to now possibly by the end of this year, we'll have too many refineries online, which should bring that crack spread way down. And also, refineries are the ones that buy crude. Consumers buy products. So if the refiners keep processing more and more crude, you'll see that pull on crude prices. At the same time, we shouldn't we shouldn't oversupply the product market either, because we're sitting at 5-year lows, 10-year lows in gasoline stocks, in diesel stocks, in other stocks. So there's a natural buffer there on the product side as the refineries kick on here as the year goes on, and we're already seeing that. You're seeing crack spreads already come down, and I just love when people say, well, crack spreads are coming down because demand is weak, and I just say, zoom out. Look at what the Singapore crack spread was in 2019. Look at what the US Gulf Coast crack spread was in 2019. It was another $5 to $10 below where it is today. So you're saying crack spreads is collapsing, but yet we're still much higher than then. So what's changed? Well, 2021 and 2022 were the 2 consecutive years when we saw refining capacity contract. That has not happened. This is a very rare phenomenon. 2020 and 2021 were the 2 years where we saw it contract. 2022 was roughly flat. And in 2023, now we're seeing about 2 million barrels per day of refining capacity added. So it's a new regime. There's a lot of changes that's being made, all good for the bulls. We don't want $60 crack spreads and the refiners making all the money. That's not good for us. We'd rather crack spreads 25, $20 to $27 to $30. You can still make money on the refining side, but don't get too greedy here, because it does impact the consumer just the same way that oil price rising does.
You said you were looking at financial implications or financial things that impact the price of oil. What are you looking at? I'm curious for my own self. What have you been looking at from the financial side that may impact the price of oil?
The open interest. That's really your end all be all. Your open interest gives you 2 things. It gives you longs in the market. Traditionally, the oil market, and again, this is not something I followed for too long, so this is just something a more recent, but traditionally the oil market is 7 longs to 1 short, or 8 longs to 1 short. When you get less participants in the market, what happens? Now you have 4 longs to 1 short, or you have 4 longs to, or sorry, three long contracts to 1 short. And what are the long contracts? They are the ones that are buying crude. So when you have less people that are literally on the financial markets buying crude, the price of oil seems to go lower, as it would with any other commodity. And the second thing is liquidity. So when you have less participants in the market, you see this wild gyrations up and down within weeks or even within a day. Sometimes we've had these days where WTI will drop $5, recover that, and then drop another $2 by the close. That is not a sign of a healthy, high liquidity market. And that's just what a 4 to 5% interest rate environment has done. It's knocked out people. The margin requirements are a lot higher on some of these contracts now, and your safety net's a lot lower. When you're running 5-6x margin on a WTI or a Brent contract, and you get a 5% move downwards, that is absolutely catastrophic. I mean, you can make a lot of money, but you can get wiped out in a matter of hours in this game. And so certain banks and certain institutions just won't play the game. They say we're out. We cannot afford this sort of expected value volatility here, especially on the downside. So that's more the impact here. Obviously, one thing to keep in mind is 2010 to 2014, we were in a 0 interest rate environment for a lot of that. So that was that $100 barrel that we had then, inflation adjusted, yeah, it's a lot higher, but in a 4 to 5% interest rate environment is going to be a lot harder to get to, and that's a reality that I've sort of had to agree to now. I've had to accept that that yes, the financial markets are not really what drive the price of oil in a lower interest rate environment, but in a higher interest rate environment, we need massive physical undersupply to drive the point home, and then once the inventories are lower, now you can run with a lower undersupply and still get that higher price that the world needs. And just to kind of get a off-topic point here is OPEC is not looking for higher prices. They're looking for prices such that the oil markets are healthy. And for oil markets to be healthy, you need investment. Who's investing at $72 oil? Nobody. the shale rigs are coming down, the Canadian rigs are coming down, global conventional oil, there's nothing really happening to spur investment. And what does that create? That creates a larger and larger supply-demand gap further in the future. And at some point, it's going to be, well, now we can't do anything. And you get this massive spike in oil. Nobody wants that, including OPEC. It's not good for their business. It's not good for oil in general. So just try and kind of think about things a bit differently. OPEC is not trying to just increase the price of oil for the sake of printing more money. They're doing it such that investment comes in and they can help OPEC in creating a really nice supply demand in the future as the years go on.
So how much do you like or dislike natural gas? And why?
I can tell you from my portfolio construction perspective, I have bought options on natural gas heavy companies for late this year. So I'm not betting on anything short term. I'm once again using what I call the shale rig lag. So there's a lag of 6 to 9 months between, first of all, prices need to stay below the marginal cost of supply or the marginal cost of profit, let's say 2, 3, 4 months for producers to start feeling the pain. Then they start dropping rigs. Once they start dropping rigs, there's another 3 to 6 to 9 month lag by the time production drops materially. So natural gas has been below $3 for how long now? 3, 4, 5 months. And
Yep.
we're seeing that rig count start to come down. We see some of the Q1 commentary saying, hey, we are going to drop a frac fleet in mid-May. We're going to drop another rig in late Q2. And you're seeing that play out as time goes on. So I'm not going to bet on anything near term. Do I like natural gas as a commodity to bet on? No. Do I like natural gas at $2.20 per MMCF or per MMBTU? Sure. The risk reward on it, from my perspective, is pretty good. Would I bet on the commodity? No. It's absolutely crazy commodity to bet on in general. But would I bet on producers that are benefiting materially from natural gas prices rising as the year goes on? Yes. So that's where I place my bets. Not really looking into it any deeper than that. I think people have gotten way too bearish on the supply and demand fundamentals of natural gas. You got to realize when natural gas comes down, yet coal prices are still high, you're gonna see changes in the natural gas generation mix in the US. We just hit, I believe it was today or yesterday, an all-time high for natural gas burned for power consumption in the US. So there's going to be product changes that happen depending on pricing. Of course, Europe doesn't have the Russian pipeline imports this year. We have Asia now back on the market. Hey, last year prices were $20, $30, $40 an MMBTU. China, Japan, and Korea said, go ahead, buy all the LNG you want. They told Europe spent over $1 trillion buying LNG last year. Now prices are $10 to $12 an MMBTU. So what are Japan, Korea, India, Pakistan, Bangladesh, China saying now? Okay, we'll grab some more cargoes. If you guys don't want them at this price, we'll grab them. And it's more of a bidding war that happens as things go on here. So generally, right now, I don't have a strong view. 6 months down the road, I'd be very happy taking a bet at a $2.50, $2.75 strip. I think that's a relatively good risk reward bet. You're never going to bat 1,000 or you're never going to bat 100% anytime. But if you can hit a couple of home runs here and there, that's kind of what we're looking for here. And I see the opportunity where there's some soft pitches being thrown, and I'll take a swing at them here for 6 to 9 months out.
And what's your opinions around energy service companies? Because I know a lot of people, they like the exploration production companies. Some people talk about the energy service. What's your opinions around the energy service side of it?
I've always been bearish energy services. I think people that have followed me know this, and I'm not saying that from a financial standpoint. I'm saying that from a real life standpoint. I've run many wells. I've operated many wells for many companies up in Canada. whether it's Northwest Canada, whether it's Saskatchewan, heavy oil Alberta, we used to absolutely squeeze the service providers, absolutely gouge them. They had no say at all. It would be like, you were whatever, a 10-year-old kid, and your brother was 3, and he got a new toy. Well, it's so easy for you to just grab it and just keep it and tell him to screw off. So that's effectively what it was. It was so hilarious in one side how people would be running businesses like this, and it was sad on the other side because you could just see just a weird dynamic that had been created. And I heard last year that this dynamic was shifting. Yeah, maybe it is shifting a little bit where the service providers have more control because they've lost a lot of rigs, they've parked a lot of equipment, and they're kind of not really willing to bring it back unless they get the right price. Great. Well, let me ask you this: in a $75 to $80 oil environment, what if you tell the producer that you're not going to decrease your rates? Okay, see ya. We'll see you when prices are higher. We can afford to wait till prices are $90, $95, $100 a barrel. Now it makes sense to pay you that higher rate for your service rig. So no matter how you spin it, the E&Ps have the control. And I don't like to invest in companies that are the price. Not only are the price takers on WTI, they're now price takers on a derivative a standpoint, on a secondary level on that going forward. So are there good opportunities out there that are having really good free cash flow, that have very good EBITDA margins, that have really good book values? Yes, there is opportunities out there, I think. But from my perspective, if I'm going to take that risk on and go into some of the service names, why not just invest in a junior growth E&P, right? Like for me, it's just an easier bet to make. I only have one commodity to look at. I'm not dealing with internal cost inflation on labor, fuel, mechanics, maintenance. Keep in mind, a lot of these companies have older fleets, so they haven't spent capital on their rigs or their service equipment or the frac fleets in years through the down cycle. So now, oh, hang on a sec. Instead of paying your mechanic $80 an hour that you did 3 years ago, now you're paying them $150 an hour. There's a lot of internal inflation that these companies are dealing with. Are there parts of the sector that are attractive? Tankers, offshore drillers, onshore drillers, whether it's the service side, the frac sand suppliers. When we say service side, people just look at drilling companies. There's a lot of other service stuff out there that may end up being more attractive. But from my perspective, the time it takes to understand service companies, their margins, how the margins shift quarter to quarter, it's just not worth the squeeze. Unless you work in the industry and you know these things inside out, you've got lots of connections. As a retail investor, it takes way too much effort, very opaque industry. Whereas with the E&P, I can tell you right now what every single company is going to report for their Q1 production, because I already have that data from the energy regulator. I already know what WTI price was in Q1. I have a rough idea of the operating cost for Q1. I can run a cash flow model that's going to be 80, 90, 95% accurate before I even get there. Service companies, how do you know what their margin was? How do you know what their day rate was? How do you know what they were paying their guys? Right? It's a lot of opaqueness there. So that's why I avoid it. But for the people that know this industry, that's your edge. If you think that's your edge and you can make money there, it's a part of the sector that's even more possibly opaque, and you can have an even bigger edge if you choose to put in the work.
And so when talking about exploration and production companies, and I know that you know them pretty well, you worked in the industry, all that stuff. When you go and you evaluate a lot of these companies, what are some of the top things that you use to evaluate the companies that separate these companies from, I really want this company to, I don't really care about this one? What are some of the traits that those companies have that you're just like, God, this is such a good company because of, and I don't know what that thing is. What is that thing that you look for? What are a few traits that you look for in the exploration production companies that just separate them quite dramatically? Is it well cost? Is it, I don't know whatever it is. What are those separation factors?
Sure, yeah, absolutely fantastic question. I think one that every investor should think about when they're investing in their own companies. Before I talk about the factors, I will say this. When you are looking to invest in oil and gas companies, don't look at the strip price of oil. Don't look at the spot price of oil. Don't look at some estimation of what's going to happen based on Goldman or whatever. You make up your own mind. Look at all the different resources out there. Look at the supply demand. Look at the factors that are changing. Look at where the economy is, whatever you want to put into your model, and have an idea of what oil price you think is going to be for your investment time frame. So if you've got a 3-year investment time frame, you think oil price is going to average X dollars per barrel over that time frame, and this is the lowest number that it can get to for this period of time. I would look at those two things, then you pick companies. You cannot just pick companies and then say, oh, is this going to survive 10 months at 60 WTI? And I also want the highest torque company. And I also may sell this in 3 months or may keep it for 2 years. It's very difficult. You will get squeezed out of the trade. That's what's going to happen. You're going to buy the company. You're going to go through a drawdown like we're going through right now. You're going to say, all I want is to recover my money and then I'm out. You'll recover your money at some point. You'll get out and then you'll watch the cycle take off and you'll end up missing the entire thing or whatever it is. So I really think X investor needs to have a good understanding of oil macro, supply, demand, inventories, make up your mind on oil price, and then look at the factors that I'm going to talk about here. So obviously, for those that know me, I have a bullish view. It is a structural bull cycle that can only be solved by supply. So you can have a recession, short-term recession. Okay, did you fix anything? Did you crater demand permanently? No, that's never happened in the history of oil. Did you add more supply in a recessionary cycle? No, in fact, you reduce supply. So that wedge on the undersupply is getting larger and larger. If there's a technology breakthrough somewhere in the world or in shale, that supply comes on massively. Okay, now we got to look at our thesis and readjust. Until that happens, my thesis is we are in a structural bull cycle. Yeah, is there going to be volatility and drawdowns? Sure. But we are headed towards a higher for longer period that creates more investment, that creates more supply, that then creates an oversupply at some point down the road, and then we'd be in a structural bear cycle. So this is the way oil has gone ever since it was invented, or ever since it was found and explored and developed. So with that sort of structural bull cycle in mind, if you believe in that thesis, which I think if you really want to invest in oil in a major way, you have to believe in that thesis. I've never agreed with the people that said, oh, these companies are printing money at $70 oil. That doesn't mean you should be investing in these companies, even at 3 times cash flow, because you're suffering a lot of risk and volatility for very little reward if oil stays at $70 for the next few years. So anyway, I'm kind of digressing here. So once you agree with that structural bull cycle, or you don't, whatever, the factors that I would look at are, the number one thing is your free cash flow. The companies have to be making free cash flow, and they have to have free cash flow torque. So run your numbers at whatever WTI it is today, whatever free cash flow they made, and then whatever projection you had for the cycle, run it at that price. They have to have free cash flow torque. This is why I can't buy royalty companies, for example. They don't have that free cash flow torque that I'm looking for. So it all starts with free cash flow, because that's what drives your multiple. That's what drives your buybacks, your dividends, the ability for the company to pay that back to you, along with debt reduction, which comes back to the equity value. So number one is that. Secondly, I would look right now, if I was investing right now, I would look at tax pools. Companies that have tax pools, as in tax protection for the next 12, 24, 36, 48 months, are going to be a lot better off. Because while their valuations are cheap, they're not paying the tax man. They're going out and making really good acquisitions with that tax money. They're going out and buying back shares at very attractive valuations. They are, and I don't necessarily agree with this, but they're out giving you the dividends back to generate a more stable shareholder base with that money, as opposed to strictly, oh, here you go government, here's my 23 or 22% of the money. I mean, I've not strictly avoided companies, but I've tried to avoid companies that have zero tax pool and right now are fully cash taxable. And then you want your upside. And how do you get upside in a commodity or an E&P that's always declining? Companies' wells are always declining. It's not easy to find reserves. You got to go and explore. You got to go and delineate. How do I do this? I look for companies that have tier 1 acreage. So you want companies that have the best of the best acreage in whatever area they're in. They don't need to be in the sexiest field in the Permian, Delaware, Lee County, or in the Montney, tier 1 this. Any field that they're in, whatever their expertise is, they need to have tier 1 or what I would call tier 1.5 acreage. So a split between tier 1 and 2. They need to have that because that protects them on the downside. They're able to drill wells with really good capital efficiencies. And then on the upside, they're now, when oil prices do go higher, you're able to get way better netbacks, way better production out of your system and drive production growth if need be with much fewer wells drilled. Or you can keep your production flat with a lot fewer wells drilled, which means less CapEx. So look for inventory quality. And a second point to inventory quality is undeveloped land. There are companies out there that are sitting on huge chunks of undeveloped land that they haven't really drilled, because why drill it in a $60 oil environment? Why drill it in a $50 oil environment that we had from 2015 to 2019? They just sat there, they kept production flat, or even let it decline a bit. They made really good acquisitions in 2020, in 2021 at extremely low valuations and low WTI prices. And now they're just sitting there with these undeveloped land and inventory that doesn't show up in reserves, because to show up in reserves, you have to have a well drilled, and then you get credit for reserves in a radius around that. So whatever else is there is just sitting there quietly. Now, this is something you're going to have to put in the work. It's not going to be given to you in the presentation. You're going to go out there, look at the acreage of the company, see what trends they're in, see the adjacent wells drilled, talk to the company themselves, talk to their geologists, talk to their engineers to the point that you have access to them. Look at their corporate presentations, look at their technical presentations. Some of these companies, they'll go out to SPE, they'll go out to geology conferences and other energy conferences and present on their technical side of things. Trying to go into those sorts of things, understand what they're doing, and that is what's going to drive your diamonds in the rough, let's call it, as the cycle continues in an 80, 90, 100 plus dollar WTI environment. These companies will go and start drilling this acreage, and then they have optionality. They can grow production, they can keep production flat there, they can delineate the production and then sell it. So they can kind of monetize part of their assets that way in a higher multiple environment. So really, that's the companies I look for. If you look at my portfolio, that's exactly what I have. On the non-junior companies, my top 3, 4, 5 positions, they're all non-cash taxable. They all have undeveloped land upside. They all have free cash flow torque. And part of having free cash flow torque is having a bit of financial leverage. I don't like debt-free companies. They're not run properly, in my opinion. That is way too conservative a balance sheet to run in a commodity industry. It's too safe. So all of them have some sort of financial leverage. And I just let them run through the cycle. That's why, if somebody asks me, what changes have you made to your portfolio? I say, nothing. I don't need to make any changes. I'm not playing a 1 or 2 month time frame. I'm playing a cycle. And in the cycle, I found my horses, the thoroughbred horses that have been hitting the gym. They've been out there touring the fields. They've been getting the training. And now they're ready for their Kentucky Derby as it goes on. And they're going to win a lot of these races in a structurally bull cycle, which over the last few months we haven't been in. So the short-term part of this cycle has been a drawdown. And so rating these companies or trying to judge portfolio performance in 6 months out of a 5, 7, 10-year cycle I mean, feel free to do so, and I'll look at my portfolio performance over a longer time frame, and it's been a fantastic ride so far. So I'll keep betting on these horses, but I would advise everybody to do their own independent research and look at the companies. Try and understand these companies, especially if you're going to be invested in them over a cycle. You really want to understand what they do. This is not a just throwing darts or playing roulette. This is you're picking your horses, so you got to get to know them and really understand them, and they will reward you accordingly.
So when evaluating these companies, another thing that I always do, I'll give you my approach. I do a risk reward kind of look at something. I say, hey, what's the upside potential and what's my downside from where I'm potentially buying it? How do you evaluate these from like a risk standpoint? A lot of these companies, what are you looking for? What are some red flags? What's the risk side of this equation for you?
The risk side of the equation is your cash flow multiple. So if companies start trading at much higher cash flow multiples, that's your risk side of the equation. Where we are today, the shareholders that are left in these companies, they've gone through immense volatility. They are exactly the investor I described, the structural bull investor. They're not tourists and traders who came in for a short period of time. They have all been wiped out. They said, this isn't for me. They weren't able to sleep at night. They were thinking about strange things. So they said, I can't be doing this oil industry. This is not for me. And they were feeling stomach pains, so they left. The people that are left are the people who are investing in a structural bull environment. So I think that provides a support at whatever multiple you want to call it, 2, 2.5, 3 times cash flow. There's a support there, and guess where we are? We're right at that support. So given that sort of thinking, the risk level here to the reward level, is the risk still there? Yes, but at $68, $70 WTI, the reward is just immense, and that's really what I can say for per unit of risk that I'm taking on. The reward is 5, 10, 20x what I can get in the broader markets. And be very careful as an investor. Like, you want to be cognizant of that you are taking on units of risk, but those units of risk have a higher return profile, a order of magnitude higher return profile on them compared to the other parts of the market. So that's how I look at risk. Can we get to a major credit event and oil price absolutely gets clobbered and the equities return to what they were in, call it, late 2021? It can happen, but expected values. We got to run everything at an expected value probabilistic model, and then you got to decide what you're comfortable with on the upper end of things. Just to back up my statement, in 2012 to 2014, companies were trading at 8 to 10 to 12 to 14 times cash flow. It happens in every cycle. When the cycles come down, people say, oh, you're never going to see this again. Oil is dead. Nobody wants to invest in oil. And then people chase money. What's the one true thing about human nature? People want to make money, especially in America. And they will chase the industry that allows them to make money, especially in the structural bull cycle. We have this near-termism thinking that nobody wants to invest in oil and all this. Well, I can tell you, people do want to invest in oil. They just don't understand it yet. So as the cycle continues, as the oil price stabilizes, as the companies keep generating more and more free cash flow, paying out higher and higher dividends, you will see money return. And am I saying we're going to be at 14 times cash flow tomorrow? No. But when I run my high-end case of the blue sky of what can happen on an expected value model, I have on one side a major credit event with a $50 oil price for 6 months, whatever. Not saying that's exactly what I'm running, but just as an example. But a lot of people just leave it at that. They don't run the high-end blue sky scenario. Well, if you're running a low-end catastrophic case, run the high-end case as well, and you'll see your expected value ends up being a lot higher than it is today. And that's literally where I mean, I feel very comfortable in these equities, especially because a lot of the oil investors did exceptionally well in 2022. So we're already beating the market by a large amount and have a bit of a safety net to play with. Not that people should be thinking that way, but it does give the average investor a lot more confidence of what can happen when things do turn our way, because we've taken a lot of punches in the last 6 to 9 months. We've taken a lot of punches right in the face, and we're still here standing, and the next round is beginning here. So we're angry, we're aggressive, and we're looking for a knockout here. We're not looking to just punch you. We're looking for a knockout, and that's what we're betting on.
So another thing that I look at, maybe I can get your opinions on it, is when we get big pullbacks in the market, especially oil, I look for those high cost producers or the higher cost swing producers. They usually get just pummeled to the downside in these markets when the price falls back down. When it then stabilizes the oil price itself, those guys generally kind of get yanked way down, and then they lag a little bit, and then they start to come back up as the price recovers. Would you say that those kind of swing producers, I know you could almost say that Canada they've got a lot of swing producers up there to some extent. Do you think they're better priced today than maybe those ones that are kind of older, more stable producers?
100%. I don't even think it's something that people can argue. When you look at something like a CNRL or an Exxon compared to something in the small to mid cap range, it is a big difference in the valuations that we're seeing. And just to continue on your point, not only is it the high cost producers that end up getting pummeled, it is the producers with more financial leverage and more asset retirement obligations, which sometimes are the higher cost producers, just in general. So they end up getting overly whacked and provide really good entry points. I mean, I'll be completely honest with you. My portfolio is fully transparent anyway, but a lot of my producers do fall in that category. A lot of my holdings do fall in that category. So we are betting on that return on them in a much more exaggerated fashion. And the same applies for some of your junior companies that are in growth mode. And the reason is not because they're high cost producers in general, it's because a junior company just has a lot more operating costs. They don't have the scale, they don't have the lower cost of capital. They have to pay a lot of G&A per barrel. And as they grow, all of that comes down. So they end up benefiting not just from oil price recovering, but from them growing production and generating those efficiencies of scale. So there's a company in this market for everybody, whether you're the safe 12% dividend wanting investor, or whether you are a very aggressive growth investor, or whether you are like you and I. And then as you mentioned, there's this other investor, which is sort of your value investor, who is not necessarily looking for growth, but they look for opportunities where the market has unfairly pummeled some of these, call it higher cost producers, and they end up seeing an opportunity to enter these names. And that's kind of where we sit today. I mean, you know, when you first asked me for this interview, I said, you know, do I really want to be giving interviews when prices are so low and the general call it climate is just so bad? People are kind of getting worried. People are not supportive of the thesis anymore to some extent. And I said, you know what? Not only should I be giving this interview as my own kind of responsibility to share my thoughts and give people an update, but also because for those who are value investors, this could be the opportunity you were looking for. And so, I mean, I'm not going to say anything investment advice wise, but if you are a value investor and you're looking for an absolute collapse in society to enter oil, it's not going to happen. So pick your spots, pick whatever you feel comfortable with. And, you know, if you really believe in the oil structural bull thesis, or even just for a short-term trade, the market is giving you lots of opportunity. I find people are looking for an absolute collapse of oil to $30, $40, $50 a barrel to enter. Well, you know, if you feel that's the case, then all the power to you. I just don't think it's going to come. And people just keep shifting their goalposts to lower and lower and lower oil price before re-entering. And yeah, I guess I'll leave it at that. That's the point I get across to my friends and family and people who kind of ask me about what's happening. And I just sort of leave it there and let them do their own work after that.
Here's a question too, and this is from my perspective. I just want to get your perspective. And it's from an investment mindset versus a trading mindset. I have an investment mindset, not a trading mindset. At these prices where we are today, would you feel highly uncomfortable not being invested in the companies you're in? Or do you feel like there's still a lot of risk and you're like, you're struggling to hold them? My mindset, since I'm an investor, I struggle to not hold things. I'd much rather have a 20% pullback in a stock than see it go up 200-300% and not be in it. Like I struggle with that big time, and I cannot chase price. So, what is your mindset with regards to that? And I focus on the big bull market case. I think that's exactly what you do, the structural bull market. So I'm an investor, structural bull market. Do you have the same mindset kind of as what I've described?
Yes. So the short answer is yes. The part of it that I struggle with is that I do run a margin portfolio. So there is excess risk at certain points in the market. You get excess risk that comes into it that you're taking on as a margin investor, because that 20% drawdown will end up being a 35 or 40% drawdown on my end. And that's when it becomes very difficult to stay invested in these names. That's also when you don't want to sell these names, but Mr. Bank Teller calls you and says, hey, you got to meet this money. You got to put money into this account. And so if you want to avoid those situations, you almost have to be more proactive in managing portfolio risk. So I think anybody here who's listening, who's on margin, may treat things a bit differently. But anybody who's in a cash position, a cash portfolio position, no leverage, I think it's very hard to stay out of these names both at the valuations they're at the WTI price we're at, and then the sort of expected risk reward model that we discussed. It's very hard to stay out of these. Once they run. These companies, they will not stop. They become momentum trades. People do start chasing them on the way up. There were certain equities in a less than 6 month period last year, from December of 2021 to June of 2022, ran up 150, 200+%. So it's very hard to chase those names. When you say you're going to miss a 200% run, you're not lying. That 200% run was not in some random company. That was in serious small to mid cap companies that had that sort of run up in a sub 6 month period. And I would argue today, those companies are much better off because they paid off a lot of their debt. They bought back 8, 10, 15, 20% of their floats. So they're even more, in some sense, attractive entities to invest in. And that's why I think a lot of us are still here. Honestly, if we didn't believe that we had a multi-100% run up here that's going to happen throughout the cycle, whether it's shortened or lengthened, I mean, that's a subjective view. But if we didn't think that, then the risk here makes no sense. The risk and the volatility to subject a human with emotions to these sorts of swings is just not something any rational person would do. So because we see these, call it huge upside opportunities on the other side, is the only reason we can call ourselves normal and not that we've gone crazy here. So I'm in total agreement with the way you're seeing that. I think that's the only way it makes sense to invest in this sector. And that's why I think it only makes sense to invest in this sector if you, to some extent or other, believe in a structural bull thesis. People who are sitting here and saying at $70 oil, I can still get an 8% dividend and sit here, that is not the way that I would be thinking about oil and gas markets. Because I've seen this. I've been in oil and gas now for just about 10 years. and it can wear you down. It will break you. Even the most strongest of individuals, it will seriously clobber you. And I laugh about it now because I've been through that personally. And it's not for the faint of heart. Anybody that tells you these oil markets are easy are people who started investing in 2020 and they invested till 2021 or 2022 and they thought it was a joke. Well, this is what markets are like. If you're trying to make incremental return over the S&P or over inflation or whatever else, you will pay for it with risk and volatility and downside. And you got to pick your spots where the risk reward is skewed in your favor, the odds are tilted in your favor, such that hopefully we can end up with a much higher return. And that's where I see oil markets today, and that's why I see it very hard to stay outside the market for any period of time at this point.
So is there any questions that I missed or anything else that you'd like to add for the viewers?
I think everything else is basically covered. I would just say that yes, the financial markets are more now in control than even I thought 3 months ago, especially because of the banking issues happening. So we've got not just interest rates and margin rates higher, we also have some credit seems like problems, which results in even lower liquidity. So definitely be nimble, be proactive, look at these things. Don't just buy them and leave them and say, oh, we're in a structural bull cycle, we're good to go. Understand the day-to-day happenings or at least the week-to-week happenings of what's happening. Look for opportunities to enter if you are looking at this market. And then everything on the physical side, I mean, is looking good. Be very careful of cherry-picked data, of cherry-picked narratives, of completely wrong narratives, like the diesel demand is collapsing narrative. Not only was the entire narrative wrong, Bloomberg picked a data point from a week when China had a long weekend where everybody stays home with family, and they used that to tell you diesel demand was down 8%, and just verify everything you're seeing out there. There's a lot of money behind these moves. There is a lot of lobbying behind these moves, and certain news agencies can be paid to pump a certain kind of narrative, no matter what it is. So act independently, have access to the data, understand what you're investing in, understand the companies, and understand what you're looking for out of this cycle. It's nobody's in here for a 10-20% gain. We're in here to hit home runs and grand slams, and I think it's gonna be a fun cycle here going forward. And just take care of yourself too. Don't get into these sort of woe is me sort of narratives that also I see some investors get into, like, oh, why did I ever get into oil? This is completely, I was fooled, I was mistaken, and blaming themselves for things. This is just how markets are supposed to occur. This is how markets generally are pre-COVID. So we are in a new regime now going forward. We have not been in a non-zero interest rate environment, at least to this extent, in many years. 5.25 is the highest we got to in 2004, 2005, roughly, before they cut in 08. So we are at the most tightened environment we've been in a long time, and that can seriously affect the way the general markets function, because markets are a financial instrument at the end of the day. So keep track of the physical data. I will keep sharing whatever I can on my feed as well. So not trying to pump my feed, but I do like to post a data focused stuff, not opinions or what somebody else posted. So keep track of the data points, keep track of the OPEC cuts that are happening and sort of what happens out of that. And yeah, I think that's kind of all I can say is we're back to the markets the way markets functioned pre-COVID. And although I'm happy to be back in that environment because it's a more normal environment, I feel like a lot of investors are caught off guard suddenly that, oh, how come we're not making 10% a month anymore? This is like this is unacceptable. This is unfair. Well, you're not supposed to make 10% a month. The best retail investor, the best fund ever, made a 30% return over a 10-year period. And some of you people are sitting here with 7, 8, 900% returns in the last 3 years. It's not normal. So keep your expectations in check. And I'll always play at any table, at any game where the odds are tilted heavily and skewed in my favor. And that's where we are today.
And if they want to follow you on Twitter, what's your Twitter handle?
Yeah, so my Twitter is at White Tundra SG. I also have my website, whitetundra.ca. My portfolio is fully public. I also host Zoom sessions, so almost 2 to 3 Sundays a month. I've got Zoom sessions completely free. You can come online. They're also on Twitter Spaces. I share all kinds of details on companies, on different macro, different supply-demand fundamentals. And in 2023, I've been focusing more also on petroleum engineering topics. So we discuss broad macro, we discuss all sorts of topics. I just had a Alaska focus session from last Sunday that is now online that also had a 45-minute brief macro update. And then next Sunday here, May 7th, I have a what I call a Petro Ninja Wells update. So we will go through companies, new wells they've drilled in the last 2, 3, 5, 6 months, look at how they're doing, look at some new technologies that are coming online. So when I talked earlier about what factors should you look at and look at undeveloped land, you should look at tier 1 acreage. That's exactly what I will discuss. I will show you wells that are tier 1. I will show you wells that are tier 5 and why there's a big difference in the companies. We'll also look at some undeveloped land packages this time around. So it's not just a wells update. I will show you some undeveloped land and why these companies that have this land, when I look at proxy wells, when I look at where that land is a huge value generating opportunity in the future. So that's kind of where I'm most active. My email is also on my website. So I've actually had quite a few of your viewers over the last 6 months say they found me on your channel and reach out. So feel free to email me if you have any other questions. I try to respond to, so far I've responded to every single email that I've got ever since White Tundra was launched. So I do, there is a delay sometimes of a few weeks, but I do get to things because I just love this, and I love the passion, and I love sharing the story to anybody that cares to listen.
All right. Well, thanks for coming on today. Really appreciate it. And if you guys are interested, definitely add them to Twitter and reach out. And thanks for viewing. So you made it to the end. We'll catch you later. This is Finding Value.
Thank you.